Chief Investment Officer at SFG Alternatives, who joins us live from Chicago. Larry, great to have you with us today. Thanks very much for joining us. Talking about these great moves that we're continuing to see there for oil, in particular with Brent. It's continuing to make its way above that $60 mark. A lot of optimism being priced in here around an extension to those OPEC production cuts. You just wonder if that doesn't happen. There's a lot baked into the market right now. What's going to happen if we don't actually get that extension?
Yeah, that's a good question. I think also we have to realize that it's not just the supply or the lack of supply. Demand has been very steady, especially in middle distillates. So that's been really helpful to the market. When it comes to Brent, as you had mentioned at the break, that is trading at the biggest premium to WTI in a long time. 250,000 barrels a day went offline in Iraq just most recently, the supply disruptions. So those things tend to happen. But you know, we're in the midst of the first synchronized global recovery that we've had in well over 10 years. So it's no surprise that Brent is up as much as it is. On the WTI side, I still think mid-50s, where it is right now, is where we'll end the year. And I said that from the very beginning of the year, and even when it dropped down into the 40s, I really felt like mid-50s felt about right for a lot of different reasons, especially that demand continues to be good.
Well, speaking of the demand side of things, we were talking about China a little earlier with Tim Mulholland, just talking about the manufacturing sector sort of slowing yesterday, but overall the demand from China still seems to be very, very good. I wanted to get your thoughts on the iron ore price. Obviously very relevant for us here in Australia, and we know that it did have a big drop there at one point, but given that the demand side of things remains very strong from China, are you expecting a pickup in the iron ore price?
Yeah, you know, I can almost guess what Tim said, but I do think right now that iron ore is actually peaking right now, but it's peaking at a very high level. And we see that right now we're not seeing those broad volatile moves that we've seen even a month ago. And we see things where steel will be down. Steel is up today and rebar is down, et cetera. So I do think we're peaking right now at a high level, and I do believe that it will continue to charge higher. It's just going to be very, very hard to own the stuff because, boy, it can become very volatile very quickly. And I have called that from the very beginning of the year, and it did not look good for a large part of the year. But we did see a rebound. I do think that China's data tends to go in fits and starts like all of ours does. And so I'm pretty hopeful for the price going forward.
Mm-hmm. All right, let's talk about the market more broadly, Larry, because we're seeing those gains there once again there today. Big expectations from those tech stocks, which right now actually seem to be delivering. Of course, we know Apple this week is going to be a really crucial one. Not just corporate earnings, though. It's a big macro week as well. We have the tax bill, the FOMC meeting, US jobs as well. What are you sort of making of how the week is playing out so far and these levels for the market?
Yeah, it's very exciting. We're in the midst of the global growth trade just continues to remain in force. In the U.S., the tax trade is also providing a tailwind. This started a year ago in Japan and the Eurozone, where I went overweight there, underweight here in the United States, and still stand by that. It crept into the emerging markets the beginning of the year, and here in the U.S. was picked up steam in the last 2 or 3 months. So that said, the growth trade could continue to last for the next 6 months, I think. Whether it means the stocks will continue to go up is a whole different story. But I do believe as long as our growth numbers continue to be on the positive side of things, the PMIs, the industrial production numbers, et cetera, there's no reason why they shouldn't, because on the other hand, bonds are a lot more expensive than stocks are right now.
So if that growth does continue, if we see earnings and we see the data painting an upbeat view of the economy and we see that growth continuing, where do you think investors should be positioned? Where should they have their money in order to take advantage of that growth?
Yeah, well, I do think, just like I've said the last few weeks, I still think the value is in the Eurozone as compared to the U.S., even the emerging markets, although not so much, just because it's become a consensus trade with a lot of people. In the Eurozone, when you're buying the broad market, you are buying cyclical. So that's a good place to be when there's a growth trade going on. And also what I've been saying for the past 3 to 4 months is the financials in the Eurozone, broad exposure to that makes a lot of sense because on a relative basis, they're very cheap compared to anywhere else in the world.
All right, fantastic. Larry Shover, always a pleasure having you on. Thanks very much.
Thank you.